The Governing Council has maintained the policy interest rate at 2.25%. We have three key messages. First, after stalling over the past year, economic growth looks to have resumed in Canada. While U.S. trade policy continues to be a headwind, consumers have been resilient and businesses are adapting. Second, inflation in Canada is poised to ease, provided global oil prices decline from elevated levels. And third, uncertainty remains high. The conflict in the Middle East has re-escalated in recent days, and trade discussions with the United States remain ongoing. Canada's GDP growth was flat over the past year as the economy adjusted to new tariffs, elevated uncertainty, and slower population growth. The economy remains in excess supply. War-related cost pressures are still working their way through some consumer prices, but they're being offset by downward pressure from other prices from continued economic slack. In addition, the recent depreciation of the Canadian dollar will make our exports more competitive, but it also increases the costs of our imports. We've been looking through the direct effects of higher oil prices on inflation, but the longer they remain elevated, the bigger the risk they spill over to other goods and services. As we've said before, we will not let higher oil prices become persistent inflation. There are risks. Clearly, if oil prices go higher, they stay higher, the likelihood that that gets passed on, it broadens, increases, and there's a progression from broadening to persistence. And yes, if that happens, we may well need to raise interest rates. Our baseline forecast is that the economy is going to improve. There are risks around that, as I've talked about. But to come back to why are we feeling more confident that the economy is expanding once again? Going back to some of the data I outlined at the outset, consumers, you got to give some credit to Canadian consumers. They've been resilient. They are consumer spending is still expanding. It's not a big number. There's very little population growth in the Canadian economy at the moment, so there's not new consumers entering the economy. But Canadian households are still spending. That is supporting growth. Where we've seen weakness, we've seen weakness in the housing market. As I said, we don't expect the housing market to be a big boost to growth going forward, but what we are seeing in the housing market is after a period of decline, it is stabilizing, so it's not going to be subtracting from growth if that holds. Where we see a little more momentum than we have seen is in exports. Canadian businesses have been adapting to a more difficult trade relationship with the United States. That includes severe tariffs on a number of key sectors in the Canadian economy. It's also created an environment where there's more trade uncertainty. We're a good year into that now. What we're hearing from companies is they are adapting. They're finding ways to work with their clients. They're reconfiguring their supply chains. They're getting on with business. And the other factor is the U.S. economy is strong. I mean, the reality is they need our exports. And you're seeing U.S. businesses increasingly, increase their orders for our Canadian exports. And if you get more exports, with that, you'll probably get more business investment. We're already seeing plans in the oil and gas sector for more investment. Obviously, when oil prices are high, the value of our oil exports is higher. Companies are incentive to increase output, and so they're investing. So, when you look at the data we have, when you look at our business surveys, you're right that the overall index isn't very optimistic. But if you look at the subcomponents, you look at what companies are telling you about their plans, you can see more optimism going forward. So that is built into our baseline. And that is our best our best assessment of the growth path for the Canadian economy.